Welcome to Wacker Chemie. I'd like to share with you, we reported on our Q3 results. We started this thing off with a slight recap of the CMD, but before we get there, let's have a quick intro into what happened in our third quarter. We came in with sales of 1.4 billion, 6% below last year, largely driven by lower silicate poly volumes. EBITDA came out at 152, at the same level of last year. And the EBITDA margin slightly improved. Net debt went up to 772 million, essentially a combination of dividend payments, CapEx, and some inventory build. So what happened? We had a quarter over quarter in chemicals, a significantly higher EBITDA, driven by better plant utilization. But the big headwind in the third quarter was that we had a full quarter of uncertainty with regards to solar polysilicon sales. In the middle of the second quarter, competing technologies filed a lawsuit that asked for CVDs and countervailing duties and anti-dumping tariffs on solar polysilicon or polysilicon materials, base materials out of Southeast Asia into the US. And that has put the market a bit in a hiatus. And until our customers have an idea of what tariffs they have to price into their products, they are not willing to sign contracts or taking volumes, which I think is quite understandable. So let's move on. We had our Capital Market Day on the 18th and 19th of September in Burghausen. It was a major event. This was the first time since 8 years that we presented our site. So it represented quite an effort. What we have here is our 2030 targets, which are unchanged since 2022 when the new CEO took to the helm. There's one big shift, though. We are shifting away from a volume target, which we had previously, to a margin target. This essentially implies that we will direct less CapEx to upstream facilities and more CapEx to mid and downstream facilities, which allows us to further differentiate our product base. So we stick to sales over 10 billion. That looks ambitious, and targets have to be ambitious. Otherwise, they're kind of boring. But this looks ambitious. It is definitely achievable, but it looks this ambitious because we are right now in a bit of a market depression. So from that position, everything looks steep, but we can get there. And we can also get to 2 times cost of capital. Actually, as a matter of fact, we've proven that time and again that we can achieve that. And you can see a table with a historical performance at the back end of our fact book, which is available on our website. CO2 emissions, we've already achieved half of that transition, and there is more to come. And on EBITDA margin, well, that same goes as for the sales target. So let's move on. This breaks down the targets into chemicals, biosolutions, and polysilicon. You see that we have the most ambitious ROCE targets in polysilicon and chemicals. In chemicals, it is capitalizing on regional opportunities and a further drive into specialization, and within specialization into a portfolio optimization. In polysilicon, it is clearly the shift towards semiconductors, where we're making good progress and we're extremely well positioned, and obviously capitalizing on regional solar prices. The market is incredibly competitive, but there are some niches where we have advantages. So biotechnologies, biosolutions, we have acquired all the assets I think we need, and it's now about leveraging the technology and filling the new capacities. We're not doing this just for the sake of growth investing, but there's also a lot of focus on cost and efficiency going on. You can read our list, but let me highlight the digitalization and automatization. We are well down that road with great advances in process controls inside our plants and plant controls. So that gives us, we're harvesting literally gigabytes per second of data to continuously improve our performance. Here's the CapEx program. So about a quarter of the CapEx is maintenance of business or sustainability. And you see we're giving ourselves a range of between 500 and 800 million. Essentially, we have projects competing for capital. This is how we ensure that the most promising projects win. Capital allocation priorities for Wacker, and essentially the allure of the company. We have growth. We don't have to buy growth. We can generate growth ourselves. We keep CapEx above depreciation. We do not say no to M&A, but do not expect large-scale M&A or transformative M&A for that matter. that's not going to fly. Shareholder returns, we pay dividends. We cannot buy back shares given our shareholder structure, so we focus on dividend payouts. 50% of net income will be shared, and all of this is based on a very strong financial basis. I mean, a key priority for Wacker is to maintain its financial independence and to keep indebtedness at comparatively low levels with a gearing target of just 1x EBITDA. So let's move on again and let's get into the data for the third quarter. So sales contracted, as I said, by 6%. So 4.7% of that were volume and mix contractions, largely volume in this case. The prices contributed somewhat and FX was sideways. We had an outperformance in our silicones business. The silicones business, you will see in a minute, performed better quarter-over-quarter than we had anticipated in the preceding quarters. But we also had this disappointment about the polysilicon volumes. You see here on the left that our gross margin actually improved over last year, which is a function of higher specialties contributions, but also of a number of efficiency initiatives. Net income stayed flat year-over-year. Here's a view into our balance sheet. We continue to have a very solid balance sheet. You see an equity ratio of over 52%, over 50%. What gets reflected in working capital is the situation in polysilicon, where we've added into inventories for two reasons. For one, uncertainty as to when that hiatus ends, and B, because we had very low working capital at all in this business. We've never been able to build inventories, so now we have some. And also, when the market gets into traction again, the market is so incredibly tight for materials that are compliant with US laws that you need to have inventory to compensate for that whiplash effect. So let's start with the segments. You see here silicones moved from 80 to 90 to 109. All of that in an environment that didn't really sport incredibly great performance. I mean, some people are saying that we are in a depression or in a recessionary environment. And if you look across many industries, that is definitely the case. So how did we perform? We performed by continuing to drive our specialties volumes. They have a higher level of profitability, these differentiated products, and that contributes to earnings significantly. You see that over Q3, we more than doubled our EBITDA, significantly outstripping the growth of sales. And that is largely a mix effect. However, we are not in a situation yet in the silicones market where demand is solid or robust enough to warrant price increases. We're looking to increase prices. We're not content with just the 15% margin that we achieved in the third quarter. There should be more. But order patterns remain uneven. So were the months of April and July rather dry months, whereas August performed a lot better than we had originally expected. Outlook for the segment is unchanged. We continue to expect a low double-digit EBITDA margin, so something close to midpoint between, say, 10 and 14%. With sales in all regions at the prior year level and maintaining a higher level of volumes and specialties. Let's move on to polymers. Polymers is, as you may know, a business that is essentially servicing the construction industry globally. Now, the construction industry is not doing that well. About half of our sales are going into construction. So that holds the business back. And that's largely the case in Europe. We see construction creeping up in Middle East Asia and higher in America, in the Americas, but in Europe, construction is going sideways to down. We had a last-minute effect in the third quarter result relating to a supplier of force majeure in ethylene in Germany. Ethylene is a key product for us to make vinyl acetate ethylene. Well, the name says it already. It's in there. That left us with about a 10 million drag. So without that, we would have achieved a similar performance as in Q2 and Q1, despite a difficult construction environment. Our outlook in this business is also unchanged. We continue to see sales lower than in the last year, so not the 38, not the 7 or 8%, but with an EBITDA margin around 15%. So essentially, we expect a margin similar to the levels that we were able to show in Q1 and Q2. Moving on to Biosolutions. Biosolutions, the result shows a combination of underutilization of assets and the receipt of the first full quarter of the government's preparedness reservation fee, and largely sales growth. The 29% is largely driven by biopharma. The underlying sales growth is actually even higher because from Q3 last year to Q3 this year, one portion of the business, life science business, actually contracted. So you can see with that dynamic, we are on a good path, but there are growing pains. That leads us to Polysilicon, which became a key topic on the conference call, despite a lack of news flow compared to the last conference call, which I found rather surprising. So EBITDA margin contracted as we had a full quarter of underutilized assets. This result represents our semiconductor business and some shipments under long-term contracts, but the majority of our portfolio, as you will recall, we were in the process of transferring this away from Chinese-based prices to international-based prices, and right in the middle of that transition phase, struck this lawsuit about tariffs. So since then, we're a bit stuck here, and we have to wait. We are absolutely convinced that the supply chain will find a way. Crystalline silicon is a superior product, and the demand for this material is there. But we just have to wait until this case gets settled. The next time at the court is at the end of November, and I think by that time we will get some more clarity, and that be a first step towards an improvement. So we didn't sell anything at China domestic prices, which are by now at below $5, significantly lower than everybody's variable cash costs, while the international price hovers around at $20. And you can see our incentive there. We've updated our outlook of Polysilicon. Given that we now have the full quarter of this effect, we're now seeing EBITDA coming in between 150 and 200 million. The 150 is essentially extrapolating an extension of current conditions, and the 200 assuming that there's a late movement in volumes. In December, after the court ruling, we have our inventories already in place in hubs in Asia, so shipping out of those hubs should be rather quick if need be. And we are also adjusting our solar production, so we are slowing the inventory build. So the supply chain will react. We are well positioned. We have the right products, but it's going to take a bit of time. Patience is the name of the game. Let's look at our financial position. As you can see, the cash flow here from investing activities before securities reflects inventory build. That went up to 772 million, which is pretty much in line with our guidance, where we said that we expect a full year EBITDA between 600 and 800 million euros. And we've indicated that we see this in the upper half of that range. So the appendix then deals with some issues in accounting and modeling and others in the IRA. The IRA is the Inflationary Reduction Act in the US, where we're supposed to receive a payment for polysilicon produced in the US, but produced and sold in the US. So they're complicated, and if you have further questions on that, I'm happy to take them on. It probably takes too much time to explain this here. I'd have to say thank you for your interest. As always, Wacker is an exciting company. There's a ton of stuff going on. I think the success that we're having in silicones, despite the difficult environment, speaks for itself. What you don't see in the numbers of polysilicon is how well we're doing in semiconductors. You may know that half of all the chips worldwide, and probably in a higher proportion, the more demanding application is based on Wacker-based materials. There is a lot that is happening. So not an easy quarter, but not much of a big surprise in the numbers at the end of the day. Thank you for your time. Thank you for listening. And if you have further questions, well, you know where to reach us. Thank you.
Disclaimer. As described in the legal section on our website, c11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seed11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.